All right, let's talk about something that gets almost every investor's attention. Those juicy, high-yield dividend stocks. The big question is, are they a secret treasure that can supercharge your income, or are they a dangerous trap waiting to spring? That's what we're going to figure out.
I mean, just think about it for a second. Could your stock portfolio really pay you 10% of its value every single year in cold hard cash? It sounds amazing, right? Maybe a little too amazing. But believe it or not, some companies are promising even more than that. Let me just show you.
Look at this, 49%. That was the recent dividend yield for a shipping company called Zim. And no, that is not a typo. Almost 50%.
And it doesn't stop there. Or how about Prospect Capital? They were recently sitting at a yield of nearly 16%.
And then you've got AG&C Investment Corp. over here with more than 15%. So when you see numbers like these, it's really easy to think you've just hit the jackpot, right? But as you're about to find out, there's often a pretty big catch.
You can see why people get so excited. That promise of a 10, 15, even 20% dividend. It's so tempting. It feels like a shortcut to building this massive stream of passive income. But you know, in the world of investing, anytime you see a return that looks too good to be true, you have to ask yourself, where's the catch? Where's the risk?
And that question leads us straight to this really important idea for anyone who wants to invest for income. It's called the yield trap. This is the dark side of that big promise, and it's where that dream of high income can turn into a nightmare of losses.
So, what exactly is a yield trap? Well, here's the thing. It's when a stock's dividend yield skyrockets for the absolute worst reason. It's not because the company is feeling extra generous and giving you a bigger dividend. It's because the stock price is in a free fall. And since the yield is just the dividend divided by the price, a falling price makes the yield number look huge, even when the company is in serious trouble.
So you've basically got two scenarios, right? On one hand, you get a high yield because a company is healthy and just really generous. That's the dream. But on the other hand, you can get a high yield because the stock's price is tanking. That's the trap. The dangerous part is if you only look at that one yield number, they can look exactly the same.
Okay, so how on earth do you tell the difference? Well, we've got to put on our detective hats. We're going to treat these flashy high-yield stocks as suspects and really put them under the microscope to see if their stories actually check out.
First up, we've got AG&C Investment Corp. It's what's called a mortgage REIT or an MREIT. Now, these are tricky businesses. They don't actually own buildings and collect rent. They own mortgage-backed securities, and they try to make money on the tiny difference between interest rates. It's a really complex model, and it's super sensitive to what the Fed does.
And right away, we see a huge red flag. Just look at the history. There was a dividend cut in 2019, another one in 2020, and if you zoom out, the trend for the last decade has just been down, down, down. If you're an investor who needs reliable income, this is the last thing you want to see. It completely fails the reliability test.
But this is the real nail in the coffin. This is AG&C's payout ratio. Now, a payout ratio tells you how much of a company's profits are being paid out as dividends. A healthy number is usually somewhere under, say, 70 or 80%. AG&C's has been over 200%. Think about that. It's paying out more than double what it's actually earning. That is just not sustainable.
All right, let's bring in our next suspect, Zim Integrated Shipping. Remember that crazy 49% yield we saw earlier? Well, Zim is in what's known as a cyclical industry. That means its business lives and dies by these massive booms and then massive busts in global shipping.
And their dividend policy is, well, it's designed for that chaos. It's literally tied to their net income. So when shipping rates went through the roof during the pandemic, yeah, they paid out these incredible, huge dividends. But the second those rates came crashing back down to earth, poof, the dividend was gone, completely suspended. For an income investor, it's pure chaos.
Okay, so we've seen the bad, we've seen the risky. Let's flip the script entirely. Instead of chasing the biggest flashy yield number, what if we chased quality and consistency instead? This is where the real power is.
So what's this number? 62. This is how many years, consecutive years, the healthcare giant Johnson & Johnson has increased its dividend. Not just paid it, but raised it.
every single year for 62 years. No cuts, no drama, just a steadily growing check. I mean, what a difference, right?
You know, companies like J&J, they're part of this very exclusive club. You've got the dividend aristocrats, who've raised their dividends for over 25 years straight, and the even more elite dividend kings, with over 50 years of raises. And their secret? It's not some financial gimmick. It's just boring, resilient businesses that we all know. Think Procter & Gamble's soaps or Realty Income's real estate. Their whole focus is on consistent growth, not just a headline yield.
Now, you might be thinking, I don't have time to research all these individual companies. And the good news is, you don't have to. That's where a really powerful tool comes in: exchange-traded funds, or ETFs.
So let's take a look under the hood of a quality dividend ETF, something like Schwab's SCHD. It doesn't just grab the highest yielders out there, no. It has a smart, multi-step process. It starts with a big pool of companies that have a history of paying dividends. Then it screens them for quality, looking at things like cash flow and dividend growth. And what you're left with is a portfolio of about 100 solid companies, built for a blend of yield and safety.
And that's not the only way to do it. You have other ETFs, like Vanguard's VIG, that take a slightly different approach. Its main rule is super simple and powerful. Has the company raised its dividend for at least 10 years in a row? That's it. The focus is purely on that track record of growth. You'll get a lower yield to start, but you could see a lot more growth over time.
So after all this investigation, we've gone through the evidence. What's the final verdict? What's the actual blueprint for building an income stream that you can truly count on, year after year?
This final scorecard pretty much says it all, doesn't it? Our high-yield suspects, AGNC and ZIM, they fail across the board. Dividend cuts? Yes. Unsustainable payouts? Absolutely. Risky business models? You bet. They are just not suitable if you want reliable income. But then you look at a quality company like Johnson & Johnson or a quality screened ETF like SCHD, and it's just green check marks all the way down. They're built for durability.
And this really brings it all home. It leaves you with one simple but really powerful question to ask yourself. When you look at an investment, are you chasing a big, flashy number that might vanish tomorrow? Or are you focused on building something that lasts, something durable that can pay you reliably for years and years to come? Because, as we've seen, that choice is everything.